Well, welcome inside the Nebraska Weekly Soybean Market Roundup. I'm your host, Clay Patton, in for Susan Littlefield. So glad to be with you here today. We've got Kyle Bumsted and Alan Brugler joining us here once again today. Sure to be an exciting conversation as the markets heat up on a Friday to close out the week as a heat wave is about to hit the major portions of the growing region. This program is brought to you again by Nebraska Soybeans. Let's go ahead and take a brief break. We'll be back with more after this.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
Thank you again to the Nebraska Soybean Board for all of their support on that. As we get all back, again, we have Alan Brugler, Brugler Management and Marketing joining us, Kyle Bumsted, Allendale Marketing as well on the program this week. And men, I start here with the conversation. Positive numbers coming out this week as we come out on Friday. Grains are higher, livestock are higher, metals, energy, all of that moving in the right direction. But it's also coinciding with a major heat wave that is expected to really kind of round us out through August. So what is your take coming here into the close of the week? Alan, let's start with you. Is the heat something to be concerned with, or are we far enough in the growing season? Put it in the rearview mirror.
Well, I think you've got quite a bit of the yield development done on the corn. You're still going to affect your test weight here. Your kernel fills can be affected by the high temperatures. Look, the high overnight temperatures in particular would be a concern here. There's quite a bit of variability across the corn belt, of course, on maturity. So some areas would be more vulnerable than others. Some of them also have better soil moisture to work with than others. But soybeans, I think, are the key concern here, and you saw that in terms of the price volatility. The beans jumped up a lot more during the week than corn did. I think the corn rally on Friday was mostly short covering after being down for several days in a row. But yeah, we're looking at definitely above normal seasonal temperatures. The thing we have to remember is these 6 to 10 and 8 to 14 days. The map that's showing the big red is just showing high probability of above normal temperatures, not high temperatures per se. That actually would be better. It's better that it's in August instead of July because that peak temperature is a little lower.
Definitely a lot of things to keep in mind as we look at that. Kyle joining us. Let's talk about that livestock too, because for cattle feeders with fed cattle in the lot, it's something you're everybody a little cautious with when you see triple-digit temperatures for days in a row. Is that encouraging some guys to go ahead and get ahead on this marketing front?
Well, I think this week in particular, it did kind of force some guys to move some cattle here. You're starting to see that come into the plains here, and they said, well, you know what? It's better on a truck going to the plant than going back to the pile with it. So a lot of folks looked at that aspect of it. But for the week, we sold off pretty hard. Technically, cattle were due for a pullback here from a technical standpoint here on the charts. Now, we did see some short covering here. Most of it was non-commercial movement here on this Friday here ahead of this cattle on feed report here that we have out this afternoon, Clay.
Kind of bring it back to a roundtable discussion. The U.S. isn't the only one experiencing heat. You look at the extended forecasts in India, and they're experiencing a lot of drought there in the south, some of their highest temps on record here in the recent weeks, while they're facing too much moisture and almost monsoonal-type flooding in the north. Does that look to shift this demand picture any, and will that new demand help find any way over to U.S. grains?
Well, I think that's a good question, Clay, and a lot of that would probably hinge on the wheat complex. And we've seen here this wheat complex, Chicago wheat's been pretty bearish. I mean, from a chart standpoint, it's oversold. Technically, it's oversold. Money's left the market, but they've had good reason to because they've forced this market into 100% full commercial carry as far as the wheat complex goes. So it really says to me nobody's really interested in buying Chicago wheat. And if that's one thing that India should be interested in buying from us, is probably Chicago wheat. Now, Kansas City wheat, that spread did narrow up just a little bit here towards the end of the week. But again, that picture is getting painted a little bit more bearish as well, too. There may be a demand situation, but it's just not coming to the USA for that wheat or that grain right now.
Alan, I know you also focus quite a bit in on the cash front as well. Are we seeing any shift in basis, whether you be at the river or in the country, to suggest anywhere where we sit in a cash position right now or where farmers are thinking in this cash market?
Well, we've still got historically strong basis in several parts of the Corn Belt. We're talking 60 to 80 over for corn in some places yet, but that's because the board prices dropped so much here, and the producers aren't willing to let go of that last piece of cash. But that's what makes it complicated. It's the basis is strong because the board has dropped more so than that there's this much demand push. We do have very good demand at the ethanol plants and in the feedlots, particularly in the Western Corn Belt, where we didn't have much production last year, and they're wanting those early bushels to come in as quickly as possible. But the exports are just so bad that we aren't seeing the strongest bids that we could be seeing right now.
Men, in the second half of our program, I want to expand versus more the fundamentals that are occurring right now in the commodity complex itself. And I want to expand more to the macro market horizon. Alan, I want to start with you as we're talking the treasury yields and its potential link back to China. Now, China's had a very dismal week in an economic picture. They've seen some of their major property developers miss bond coupons, miss interest payments. Now we've got Evergrande actually filing for bankruptcy in New York. But it looks like the Central Bank of China is going to try and prop up some of these property developers. Does that stand a concern here from the Treasury perspective of Chinese investment leaving the U.S.?
Well, there's several layers to this issue here. China's economy has been slow ever since the COVID lockdown, which was extended period for them. They haven't really recovered very well. The deglobalization trend, countries trying to become less dependent on China for some of their goods and services, it means they've had fairly slow manufacturing and export growth. The central bank had allowed the Chinese yuan to get fairly weak in order to try and stimulate the exports. But what we're seeing now is they're actually trying to raise interest rates, and they're also trying to firm up the yuan, prevent it from dropping further. And one way they do that is they've been holding a lot of U.S. dollars, and rather than selling those dollars and buying yuan, they just kept them in treasuries. Now they've kind of reversed that process. They've cut back on their treasury holdings. They're converting more of the dollars to yuan. That's supporting the yuan, which would otherwise be dropping. But the corollary effect is if they're selling treasuries, they're raising interest rates here in the U.S. They're making those 10s and 30s go lower than they would otherwise, and resulting in higher interest rates and more of a challenge for the Fed.
Kyle, and really Alan brings it right up there, but Kyle, let's talk interest rates and cattle producers, because if this gets away from the Fed, where the Fed has less interaction in that interest rate market, where they're really dictating that number, if treasuries help keep interest higher, what does this do for the cattle producers' perspective, especially when those operating notes already at 9 to 10% here in 2023 and likely into 2024?
That's the point that we were talking about here before the show, and I can't stress that enough, is I think that heifer retention really does start to happen in a big way when interest rates do go down. I mean, you're starting to look at these animals costing anywhere from $2,500 to $2,800, maybe $3,000 going into the yard, and saying, boy, do I really want to keep that heifer around when it's going to cost me how many hundreds of dollars to keep her around for a year, 18 months, 2 years before I get a good viable calf out of her? I mean, can I really afford to do that? And I think that's one of the key things that we're looking at here in this complex, saying, okay, we're not really retaining the heifers yet. That will come, but I think interest rates have to come down here for some of these ranchers in order to really start that heifer retention process.
And Alan, let's go back to you and interest rates. When it comes to the row crop farmer, is higher interest rates maybe the solution to a glut of supply, especially when you look at that corn market? Will a higher operating note maybe want to back away producers from really pushing for that top end yield?
I don't really think it's going to have much of an impact. The biggest impact of interest rates on grains is your cost of carry. Okay, the time value of money has gone up, and that suggests it leans you a little more towards selling early instead of selling late. Get the cash and park it somewhere where you can pick up a yield on it. The offset to the higher interest rates, of course, is fertilizer prices have come down quite a bit and are still under some pressure here. And so I think you're going to see the producer still put the inputs on. He's he or she is still going to try and make the most efficient crop production that they can make. No, that's not to say we won't see a switch from corn to beans next year. If the corn carryout's 2.2 or 2.3 billion bushels and beans are tight, I think the crop rotation itself would favor that. But I think the interest rates are a concern, but they're kind of a background concern compared to some of these other items.
We've got about 90 seconds left here, men. We've got another week coming up. What do we need to be watching for, Kyle? What do we need to be watching for this week?
Well, I think this coming week here, we've got Jackson Hole. We've got that coming up here as far as another Fed meeting. And we've also got September grain options, corn and soybean options expiring on Friday. So I do think there's going to be somewhat of a premium move there. We also need to keep our eyes on that cash cattle market as well. Do we trade steady money with that 179 that we traded in the Southern Plains this week and that 185 to 188 we traded here in Nebraska this week? Or does the backer try to walk the cash on down a little bit more?
And Alan, the final word is yours with about 40 seconds left to go in the program. Final thoughts on this week's trade?
Well, I think the key thing to watch for this week on the grain side is the crop condition ratings. And they probably aren't going to take a huge hit because the high temperatures were just starting to come into the Corn Belt, but the market's expecting those condition ratings to go down and the yield potential that we all calculate from those. So, Monday afternoon with the ratings coming out will be something to watch. And whether the long-term forecasts, the 6 to 10, 8 to 14 day continue to show that heat or if they start to back off.
And again, as Alan Brugler, Brugler Marketing and Management, joining us today, along with Kyle Bumsted, Allendale as well. Men, thank you for all of your information and insight. And that is another exciting episode of the Nebraska Soybean Board's Weekly Market Roundup. Always check out more ag news and market information at ruralradionetwork.com.